Hello, it's Cindy Sue here. Welcome to the Chan and Naylor Seminar Night. I hope you enjoyed the video as we've got our speaker at Chan and David Naylor with lots of market updates and some government changes that's going to impact us all. Enjoy the video and feel free to contact your client managers or one of our staff for any help or any questions. Enjoy. Cheers.
Most of you, one way or another, over the last 20 years or so, and it's good to catch up again. And I hope you enjoy tonight. To start, we've got pretty packed stuff for tonight, so let's make a start. And it's my pleasure to introduce the first speaker, our founding partner, Ed Chan, to share his expertise on some property-related recent strategies, and also to offer some practical advices that you and me can maximize our investment return and stay ahead in the game of wealth creation. Please join me in welcoming Ed Chan.
Thanks, Cindy. Cindy's been with us for a long time. I think it's probably about 100 years. Although she only looks in her 30s, but she's already 100 years old. But she's joined us, I think, a couple of years out of uni. And I remember when I worked with her first 6 clients, I thought to myself, this girl's very smart. Her chatting is around, and to her credit, she's been here since 100 years now. So thank you, Cindy. Okay. Today it's we used to do really big ones. You know, there's 500-600 people in a room, and we grew so much. We ended up 10 offices around Australia, and got really out of hand. The class, so you know, the demand from the advising, the service, and so forth. But a couple of years ago, David and I sold off the other 9 offices, and we got one there, so which is Spinball. We decided to keep it very small. So small sessions, what ways we're don't look at us slow. You can talk to people, not like there's 600 people. You can't know anybody, and it's just a city of places happening. So we decided to go back, keep it a bit small and intimate. I'm going to talk about the most commonly asked question of property or shares, and I'm going to go through, you know, some of the information I've gathered. I've been in the game for a long time, and when I first started in my 20s, I'm 65 now, so I've been in the for about 40 years. Then I've consulted lots of people, met a lot of people. You see some people come through and they get very wealthy, and others don't. But there's a common theme that came through, you know, and I'll talk about. It's not what you think, actually. But the most common question people ask me is, should I invest in shares or should I invest in property? Can I have a show of hands? Who prefers investing in shares? Who prefers investing in property? Yeah, okay. So I'm going to go through, I'm going to do the macros, just big picture stuff, and then David, my business partner, is going to come over and do the micro. So he'll drill into different suburbs and talks about the detail. No selling, I'm not here to sell you anything. It's just, for us, it's about giving something back to our clients and been with us for a long time. So somebody who's been with us for 20 odd years, and it's our way of saying thank you to all of you for being loyal to us. And the knowledge, you know, you talk about healthy, wealthy, wise. I think it should be the other way around. It should be wise, healthy, and wealthy, because you need the knowledge to get the wealth, and the knowledge is everything. And if you have that knowledge, then it can make a big difference to your life. Yeah. Warren Buffett, everybody knows Warren Buffett is one of the most successful investors in the world, and he made his wealth in shares. So there's no argument about that. I mean, he's got a track record that goes for 60 years, and with he's extremely wealthy. Then you get someone like Elon Musk, who's made his money from business. There's no question that the biggest wealth creation is through business. But you can create a great business, he makes a lot of money. But then you've got to invest it somewhere. So you either invest in the shares or invest in property. But my uncle is one of the richest men in Australia. And you see I don't know whether you remember about, there was a magazine called BRW, and they used to publicise the 300 richest men in Australia. He used to be in there all the time. His name was Bertel Chan. And he's passed away now, but he's head of his wealth around his children. And his children are now in the wealthiest families in Australia. But he made his money in real estate and in retail real estate. So not residential, not any other things, just retail property investment. So for me, it really isn't about shares of property. For me, shares of property is just a medium. It's just a tool to create wealth. It's what really creates the wealth is the way you think. And you can use either, but it's the way you think that determines whether you're going to end up wealthy or not. Because, and let's face it, not everyone wants to be wealthy. Wealth can be measured in different ways. Some in terms of money, other in terms of family and so forth. So I'm going to talk about money today, but there are other values of wealth. So for me, after 40 years of consulting people and leading some really wealthy, very successful people, the common theme that kept coming through was that they thought differently, from everybody else. And when I was in my 20s, there was a book I read called Think and Grow Rich by Napoleon Hill. Did anybody read that book? Yeah. And I used to think, yeah, right. How can you think and grow rich? And it's all wishy-washy rubbish. But 40 years later, what he said is actually very true, because how you think determines the kind of decisions you make. And decisions you make leads to actions that you take. And actions that you take over a lifetime, over thousands and thousands of actions that you take, leads to outcomes. And outcomes determine where you end up in life. So if you thought the right way, you'll make the right decisions, and compound that over many, many years, you'll be very wealthy. And it doesn't matter whether you're looking at shares or you're looking at property, and how you think about how to use property or shares. Now, I'm going to talk about property today because whether you go property or shares really depends on your personality, your time available, what you're doing. When I was young, I used to go to my uncle's place, and the really wealthy uncle, because Bernard's wife, Anna, was my father's sister. So we used to go there, and they used to just talk about property all the time. So it was just part of what I did. And then when I went into practice, I naturally went into property with clients, but then I started seeing the problems from the property investment. And I'll talk about a bit of that today, but if I run out of time, it's on the slides, because the slides that I created was really for a really longer session, and subject to what happens at the end. If you want to touch on those other topics, we can run a webinar or something, and we'll just wait for the feedback from everyone and see where we go from here. But I won't be able to go through all the slides, but I'll stop when my time is up, and then David will come on, and then we'll talk about whether we do a webinar to cover the rest. So I'm going to help you think the correct way, because how you think will shape your decisions. All right. So you either work for your money, which is, some people call it personal exertion income, or you get your money working for you.
And the earlier you do that, the better it is, obviously, because it's this thing called compound interest. Now, most people start off as an employee, right? So they work for somebody else, and whilst they're working, they're learning their trade. And then some of us start our own business, which we call being self-employed. And then some of us moved our self-employment into a business. And some of us build quite big businesses, and that, without any question, generates the most amount of wealth. And then you've got to then invest it somewhere. Now, business is also very risky. So the number of businesses that fail is quite huge, right? So, so just because it is lucrative, there is a very, very high failure rate with businesses as well. So then from there, you invest your profits, your income that you generate into investments. And some of us can turn our business into an investment. Now, you can then invest in shares. It could be a public company, like buying shares in BHP or you know, all the public companies that are out there. Or it could be a private company. And for example, with David Naylor, we've built it. It's quite large now. So David and I are simply shareholders in it, and we've turned our small business into a reasonably sized business, which then runs by itself and it generates a passive income. So anybody that's running their business can also do the same. But you need systems and processes, and it can't be you driving it. Or you can invest it into property, and of course there's cash. So superannuation and all that's just a medium, and then superannuation has to invest it into one of those things. So that's the end game. So they're the only three things that you can invest your money into, and all the other things, whether they're ETFs or superannuation, that's just a medium to invest there. Okay, so shares versus property. Which is better? So this is the question that's asked of me constantly. And as I alluded to earlier, it's either one is fine, as long as you know what you're doing with it. And there's a saying that, you know, you become an expert at something after you've done it 10,000 hours. After spending 10,000 hours on something, then you become an expert in it. And it's been proven that there was this story about this guy who wanted to replace his income from his wages, from his job, with playing golf and being a professional golf player. But he was only an average kind of an athlete. So he practiced 10,000 hours, and he eventually was able to replace his income with being a professional golf player. But he wasn't earning big dollars, but he was able to earn, you know, more than what he was earning as an income. So whichever part you go into, if you get very, very good at it, and when you get good at something, it's also to do with your personality and what your strengths and weaknesses are, and what you like and dislike. So if you look at the numbers, right now, some of us like numbers, right, and I call you blue people. Some of us don't like numbers, and I call you red people. So I'm going to try and, for the blue people, you'll love the numbers. For the red people, I'll just summarize it for you at the end so that it makes sense. Because I know your eyes will roll when there's too many numbers. Property generally gets you around 7% capital gain a year and a 4% yield. All right? So yield is you divide the rent that you collect from your property into the value of the property, and it'll give you a percentage. And it's generally around 4 or 5%, say 5% for units, and there's about a 1% costs involved with costs like water rates, council rates, that kind of stuff. So you can net between 3 and 4%, but in total about 11%. And if you're getting a 7% return, it doubles every 10 years. Now, that's just called the rule of 72. So how you work it out is you take 72 and you divide by the return, and it gives you the number of years it takes to double. So You take 72, if it's giving you a 7% return, you divide it by 7 and it gives you 10, so that's 10 years. So if it's giving you a 10% return, you divide 10 into 72 and they'll give you 7 years, so it'll double every 7 years. It's just a mathematical formula. You can apply it to most things, so it's just the rule of 72. Now, shares generally gives you a 9% capital growth, but a 5% yield. So the dividends could pay you between 2 or 3% all the way up to 12, 15%. But on average, a good number would be about 5%. And at 9% capital growth, in the rule of 72, your capital will double every 8 years. Okay, so on the surface, if I said to you, what's better to invest in, you would say shares, because it's got a higher return. And you'd be correct in saying that. But what I've learned is that property and shares is just a means of making money. It's the tools that you use. And if you use it intelligently, you can actually make a lot more money. And I'll show you how. So it's just the rule of 72, which is what I was explaining. So let's say we had the choice to invest in shares or to invest in real estate. And just by way of explanation, we had a couple of $100,000 that we needed to invest, and just to compare apples with apples. And on a simple basis, you would say, well, if I had $200,000, I'd invest it into shares because it's giving me a 14% return, total return, as opposed to 11% total return. And you'd be correct. But that's just part of the exercise. The whole exercise, if you use all the tools that are available to you, then you can actually maximize this without much risk to a much, much higher level. But it requires a change of mindset, because often it's our mindset that holds us back. And I'll prove that to you throughout the night. Now, another tool that you use is finance or debt. And unfortunately or fortunately, whichever way you want to look at it, the way we're brought up means that we've got an aversion to debt. For some of us, we hate debt. Now, let me explain why it will hold you back. So what makes you money is leverage, but you don't want any risk. You want to minimize your risk as much as possible, because whenever you leverage, you're increasing your risk. So if I was to, so the bottom line is, if I can increase my asset base really quickly, so I've got lots of assets there very quickly, then if I have this much of asset and I compound it for 30, 40 years, I'm going to make a lot more money than if I had this amount of assets and compound it for the same period of time. So increasing your asset base really quickly for a long, long time is where you make your money, but you don't want any risk. Okay, so if I was to go into real estate, if I had $200,000, I'm just using that as an example, just so we can compare apples with apples, I can actually go and borrow $800,000 together with my $200,000. That gives me $1 million, and I can buy $1 million worth of real estate, right? Because the banks will take the real estate of $1 million and they'll lend you 80%. It's called a loan value ratio. They'll lend you 80% of the value of the real estate together with your $200,000. Allows you to buy something for $1 million. Now, if I wanted to leverage my share portfolio, the banks would only lend me 50%, a 50% lend. So if I had $200,000, they'll lend me another $200,000. That allows me to have $400,000 to invest. And if I bought $400,000 worth of shares, the banks will hold that share portfolio as security to lend you the money. Now, why would they lend you less? Well, actually, before I go into that, so if I had $1 million working for me, instead of $400,000 working for me, over 20, 30, 40 years, I'm going to make a lot more money out of that, right? It's just very, very basic, common sense kind of thing. And so the idea is to try and increase your asset base. So why would the bank lend you more money on real estate than they would on shares? Because I think it's much, much safer, right? Question?
The shares are much more liquid and therefore have much more
Correct. Because you can sell it very quickly, it creates much more volatility because people are emotional. So when you have a bad day, you say, I'm going to sell that, and you sell it, and it creates these big ups and downs. Whereas real estate, if you had a bad day and you wanted to sell it, well, it might take you 2 or 3 months to get it ready and get the agents and value it and market it. And that time that it takes is a natural stopping of that volatility. Okay. Now, also the bank, because it's so safe, the banks do not think that the real estate will drop more than 20%. That's why they'll lend you 80%, because they don't think it'll drop by more than 20%. Sure, it might drop, but it'll go back up, and it'll drop a bit, and it'll go back up. But they don't think it'll drop by more than 20%. So they consider that very, very safe. So they'll lend you a lot more money. Now, shares, they think that it's going to drop even 50%. So they're only comfortable to lend you 50% because it's very risky, because they're not in the business of losing money, right? The first people they protect is themselves. And of course, if you borrowed money using shares as the collateral, you have this thing called a margin call. So if the share market dropped by more than 20%, they force you to sell it to pay the loan back, so they don't lose any money. But they've only loaned you up to 50% anyway, so they're very, very safe. So the stock would drop by 20%. They force you to sell it, but you're still way. They're still very, very safe because they've only lent you 50% of the value of the whole portfolio. Okay, so what does this all mean for the red people in the room, right? For the blue people, you understand the numbers, but for the red people, if I was to make the same amount of money off a $400,000 base compared to $1 million base, so in 20, 30, 40 years, I have the same amount of money. This side here has to do 34.5% per annum, right, to equal the amount of money you make off a $1 million base using 400,000. So you might be able to do 34.5%. If you can do 34, and that's just 1 year, that's year after year after year after year. And if you can do that, then I'd do this, because there's a certain amount of risk that goes with that side because of the debt. So you've got $800,000 worth of debt. So there is, whenever you have debt, there is a level of risk that's attached to the debt. So I would do this if you can do that, but of course, that's not possible. In normal investments, you can go into high risk investments, and that might do that for you. But in just normal investments, you won't get a 34.5% return. Okay, so that's just the numbers. It's just common sense, and that's why I like real estate. It's also depending on your lifestyle and what you're doing. If you've got plenty of time to research shares and so forth, because it does take a lot more time of your time to do it. Whereas I was running a business, very busy business, and it was growing and growing. So real estate was very safe for me, and it made me a lot of money. And it's very, very safe because you always have a tenant, right? So like we've got the vacancy rates in Australia so low that you always have a tenant. So the risk is very, very low. So the bigger your asset, the more money you make. It's just sort of common sense, right? And we covered that with shares have margin calls, whereas with a property, there's no margin call. They don't call on it if the value drops. So that's another reason why property has been a better avenue for myself and for a lot of people. So I start off by saying that the difference between the rich and the poor is the way they think, right? And part of it is the way you think about debt. So the way we're brought up is we have a fear of debt. But if you understand how to use it, the debt is only a tool, right? So if you understand how to use it and you minimize the risks with it, then you shouldn't have the same level of fear. So most of us know good cholesterol and bad cholesterol, but a lot of us don't know that there's good debt and bad debt, right? Now, let me explain. Bad debt is money that you borrow to buy things that are more lifestyle orientated, depreciates, goes down value, holidays, cars, TVs, that kind of stuff. That's bad debt, right? So you should try and minimize or eliminate that bad debt, because you've got to pay it from after-tax dollars. So you've got to pay tax first, and what you're left with, then you use that to pay the debt down. So it's very expensive, and it's very, very slow in paying it down. So the less you have of bad debt, the better it is for you. So most people's biggest bad debt is the debt on their home, the home that they live in. So it's a good idea to try and pay that off as quick as you can. Good debt, on the other hand, is something that allows you to increase your asset base, and it continues to increase. So you want to increase your good debt at the expense of bad debt. So you want to pay down your bad debt first and leave your good debt alone, and make sure your bad debt is paid off first. And I know you say, well, that's just common sense, but it's really not so common. When I was practicing, clients that come in, you'd say they're paying down their good debt, and you're going, why are you paying principal and interest on your good debt, and you're doing interest only on your bad debt? And to me, it's just very, obvious, but it's not so obvious to most people. So it's important that you understand that. Paying down your bad debt. So debt's not the problem. So let's talk about good debt, all right? Debt isn't the problem. It's the inability to service the debt that's the problem. Okay, so if you're brought up thinking that debt is a problem, then that's going to hold you back. And that's what holds most people back. So if I said to you, and I asked you to answer honestly, most of you would say, I have a problem with debt. And that's normal. That's normal in the general public. But it's not the debt that's the problem. As I said, it's the inability to service the debt. Now, if you can service the debt comfortably, then I'd rather have a lot of debt. Why? Because I've got a lot of assets. I can go out and buy a lot of assets, as long as it's good debt, right? So I would rather have $100 million worth of debt and be able to service it comfortably than I would rather than have to have $100,000 in debt and not be able to service it. Okay? So again, it's a change of mindset. It's a different way of thinking, right? Because most of us just say debt is bad and we don't go into it, right? So this is all about, how rich people think. Like a rich person will go for the $100 million debt as long as they can service it. A poor person will say, I'll stick with my $100,000 debt, thanks, and struggle to pay it off. Okay, so size does matter, and debt is a tool to create wealth with. So they're all tools to create wealth with. It's not just property and shares. It's also the finance piece is a tool to create wealth with. And if you're clever and you use the tools intelligently, then you can make a lot of money with very little risk. Okay, let me explain this in another way to you. So if you've got two asset classes, one's A and the other one's B, and A gives you a capital gain of 7% and B gives you a capital gain of 15%, but the yield that comes out of A is 4% and the yield from B is 10%, and in total, A gives you a total return of 11% and B gives you a total return of 25%. If I said to you, where would you invest your money? You'd say B, okay, because that gives you a better return. But if that's all you're looking at and you don't look at the complete toolkit, because you've got a toolkit there that you can use, and if you only use two pieces of that toolkit, then that's correct. But if you use all of the toolkit, then it's a completely different picture. So let's say you start off with 100 grand in cash, right? So A, even though it's only giving you 11% return, A allows you to leverage it hugely, like 90%. So a bank would lend you 90% of the value of the asset A, but the banks will only lend you 50% of the value to B. Now let's look at the numbers for those of you who are blue orientated. So the banks will lend you 900,000 and 100,000 over this side, and the 900 grand plus 100 grand gives you $1 million. So you can now buy $1 million worth of A, and over here you can only buy $200,000 of B, because the banks have taken 50% security over that, loaned you 100,000, together with your original 100,000 allows you to invest in 200 grand. So now we've got $1 million working for you at 11%. But over here, we've only got 200 grand working for you, but at 25%, a really high return. Let's look at the numbers. Let's extrapolate the numbers out and see what they look like. So 11% of $1 million is 110,000. 25% of 200 grand is 50,000. You've got to pay interest on that loan. So there's a $900,000 loan. So you're paying interest of 6%. That's 54,000. And you're paying the debt here of 100,000. You're paying 6% interest. So you're paying $6,000. So your net is 56,000 in this area here and 44,000 on this side here. Now, if I worked out my return on my investment, what do I divide my net return into? Do I divide it into $1 million or do I divide it into 100,000? 100,000, because that's my money. Everything else isn't my money. The property is not mine because the bank owns it because they've taken security of it. The loan is not mine, it's the bank's. The only bit that's mine is 100,000. So if I'm looking at return, I've got to divide the return into my money. All right? So if I divide 56,000 into 100,000, I'm getting a 56% return, despite it only showing 11% return compared to 25% return and 44% return on my 100 grand. Right? So then you can see that's pretty clear. The numbers are pretty clear. Blue people love this. Red people go, well, what does all that mean? Right? Well, increasing your asset base and then making sure that there's no risk around the debt side. So if we can put a security around the debt side, then you do this every day, especially if you're young, because it's time in the market that's important. The longer you're in the market, the more money you make. So the earlier that you start, the more money you make. My daughter she bought her first property in Neutral Bay when she was 18. And then, that's the only reason now that she got into a house, because that property doubled every 7 to 10 years. And she then took the equity out of that to buy her property. And she couldn't have done it. She lives in a nice house today that's worth millions. She couldn't have done it if she hadn't got in really early. And most of this is just your mindset, how you think. And the way I helped her was that I put my house up as security. Okay, and because when you go buy a house, the banks will take the property itself as security and they'll give you 80%, but then you've still got to come up with 20%. And you can come up with cash for the 20%, or you can put up another asset as security for them to lend you the other 20%. So they'll lend you 100%, secured 80% on the property itself and the other 20% on some other property. So I just put up my house as security, and then the bank took that, and because it was just sitting there not working hard, so I might as well work it harder, and there was no risk to me because the market, the banks have done their research and they've considered that it won't ever drop by more than 20%. And if it did, the banks would simply sell that investment property. She'd have a 20% debt and she'd just pay that off like a personal loan. So there was no risk to me. Took me a little bit more to convince the wife. But, eventually we got there. So our 3 kids have property at a very young age because we're able to work our assets harder and not let it just sit there doing nothing. So your home is sitting there doing nothing. You might as well work it harder, but you don't want to put it at risk. So you want to put these strategies in place so that there's no risk to your home. Okay, will property, the thing that people always say to me, yeah, but property won't go up anymore. It's no way that it can go up any higher than it is. Is it? Have you ever thought that? So throughout history, they've said that. All right, so I took the liberty of going right back to, I just got some numbers out, right back to 1943. And I looked at the median property price, not the average. The average is, the median is the top property and the bottom property, and it's in the middle somewhere. Why is that different to average?
Average is the total
Yeah.
of value
Yep.
divided by the total number, whereas the median is the middle property of all the properties that's within the range.
Correct. Correct. So if you have a range of properties and they're all sort of around 500,000-600,000, but there was one in there that's $3 million, that throws the average out. Do you understand? But if you take the median of that, then that gives you a more accurate figure. So it's median, not average. Right? So I took the median property value from 1943. Now back then it was in pounds, but so I converted it to dollars. And it was 1,953. And people back then were saying, there's no way in the world it's going to go any higher than that, because we had a lack of population increase. There was a problem with getting more population into Australia. So the doomsayers were saying, that's it, that's no way it's going to go any higher. So 10 years later, and I'll explain why I did it in increments of 10 years, it was 4,360. And that was more than double, right? As you can see, it's more than double. And then that became, people saying there's no way it could increase. You know, just people can't afford it. Wages are only so much, and that's it. But then 10 years later, 1963, has that doubled or more than doubled? That's more than doubled, right? Nearly tripled, right? And then back then, we hit inflation. It was really high. And they said that there was no way in the world it could increase more than that because we had really high inflation back in the 60s. And of course, 10 years later, it doubled again. And then in the 70s, we had the oil crisis. Everybody at my age would remember the oil crisis. All the cars that came out had no power because they just dumbed all the power down to save petrol. And we had an oil crisis, and they said there's no way in the world it was going to go any higher. 10 years later, 83, it really went up. And then, of course, they introduced capital gains tax in that period, and the interest rates went up to, that was, you know, back in Paul Keating's days when he bumped the interest rates up to 22%. I remember my first mortgage. I went to the Commonwealth Bank, and there was a first home owners grant. It was a really low interest rate for first home owners. It was at 15%. And I got it down to 13%. I was, yes! You know, and it went up to 2017 and 22%. So they said there was no way in the world that it could go any higher because of the interest rates. And of course, 10 years later, it went to 188,000. And then, of course, there were other things like there was an Asian crisis and, you know, inflation and so forth. And then 10 years later, 2003, it was 367,000. And, you know, we had September 11, the GST was introduced, and then we had low inflation. They said there was no way in the world it can go increase anymore. 10 years later, 730,000. Then we had the GFC, and they said that's going to affect us. And of course, we're 2023, which is around where we are today. The prices are about the same. And, you know, we had COVID. And during COVID, they all said the property prices will plummet, 40, 50%. And what did it do? It went up. And, you know, what drives property prices up is demand is greater than supply. So if you have 5 people wanting something and you've only got 1 to sell, it'll push the price up. And our immigration is around 250 to 350,000 a year. And the supply of property is behind by around 250,000 a year. So there's a deficit. There's a constant deficit. And as far as I've been around, there's always been a deficit. We can't seem to build enough properties. We can't produce the supply of properties to keep prices down. And during COVID, immigration stopped. It was zero. And yet prices went up. They went up around 20%, right? Because there's a pent-up demand from existing buyers, not immigrants, but pent-up demand from existing buyers because such a short supply of properties out there. And this will go on for years. Now, as I was saying, Rule 72 says at 10% per annum, it will double every 7 years. And at 7% per annum, it will double every 10 years. And it's done more than doubling every 10 years. So it must be doing more than a 7% return. I've just been conservative and just said 7%. Okay, so that's our population. Now, I use this as an example just to compare apples with apples. When we're young, we all go out there and buy a car. All right, car's essential, but you can buy an expensive car, you can buy a cheap car. All right. So let's say we had $20,000. Oh, sorry, that's what cars used to cost, but they seem to go up in value now. I've been doing these slides for 30 odd years, and the numbers keep changing, and I just can't believe the numbers. I used to use 20 grand for a car, and then I used prices was 200 grand, and now it's like 800,000. The average mortgage back then was like 150,000. Today it's like 600,000-700,000. So I keep having to change these numbers. Let's say we had $50,000 in our superannuation fund, and we had a strategy of savings. We put so much in every month and save up, like what we've been told. Or we gear, right? So we take our 50,000, we go to the bank and we borrow 450,000, and the 450 plus the 50 allows me to buy a property or anything, shares, whatever, for 500,000. So now I've got 500 grand working for me instead of 50,000 working for me. And of course, car doesn't work for you. It goes down in value, doesn't it? So it'll drop in the next 10 years, it'll drop to 15,000. And I've used a very conservative number because we know that by the slides that I showed, it's doing more than doubling every 10 years. But I'm just saying, let's say it doubled in 10 years. So it's doing a 7% return. And that's being generous to a super fund. But a property will double from 500,000 to $1 million, right? And that's just at a 7% return. Let's say we didn't pay any of the debt off. Now, of course, if you pay the debt off, that's good because your net will be greater than 550 if you paid some of that off. But as a minimum, if you didn't pay any of the debt off, you used the debt as a tool to help you create wealth and you didn't pay it off, you kept it, then you've now made 550,000. So we've started off with the same 50,000. 10 years later, the car's worth 15, super fund, your saving strategy is 100,000, and your gearing strategy is 550. 550 compared to 100 compared to 15,000. Okay, if I extrapolate that for another 10 years, then the 15 grand becomes 3 grand. Now it's an antique, it'll probably go up in value, all right? And let's say being generous to super is doing 7% return, it now doubles to 200 grand. But your property is going to double from $1 million to $2 million. And again, let's say you didn't pay any of the debt off. You've now made $1,550,000. Now, the other thing is $450,000 is a lot of money today, but $450,000 in 20 years' time isn't going to be a lot of money. It's like the average mortgage 30 years ago was like 150,000, but today it's more like 600,000. Right, because of inflation and the value of money depreciates over time. So the longer you hang on to somebody else's money, the more you make from it, even just because of inflation, right? Because the value of money is depreciating. Okay, so what about cash flow? Because that's all very well, Ed, but you've got to service that. Yes, that's true. But let's have a look at the cash flow. Okay, so a rent, from a $500,000 property, the rent is around 4-5%. So for units, you can get about 5%. You pay about 1% for expenses, water rates, council rates, and so forth. Or you pay like 25% of your rental as an expense, or 1% in that manner of your value of your property as an expense, but I've used 25% of your rent. That's about 15,000 net. Then you borrow 450,000 at 6%. That's 27,000. So now you're making a loss of $12,000. So it's costing you money now, physical, real money that it's costing you. But property has this wonderful thing called depreciation, and you can claim it as a tax deduction. Normally, if you have to claim something as a tax deduction, you've got to actually spend $8,000 to be able to claim it. But depreciation is just a paper figure. You can actually claim it even though you haven't expensed it. It's the best tax lurk in the world, right? So you get $8,000. So you can claim $20,000 against your wages, against your business income, you know, and let's look at the real cash flow now. So the real cash flow is to $12,000, right? That's money out of your pocket. But then you can claim $20,000 as a tax deduction, and at a 47% tax rate, the taxman will give you $9,400 back. So you'll get that back, and it's only actually costing you $2,600 or $50 a week, and not $200 odd a week up here. So $50 a week, but it is still costing you money. Okay, so as you know, when you're running a business or you're trying to make money, you spend money to make money. So if you're spending money, you've got to make sure you're making money on the other end. So what was the capital gain we made? Can you remember? So let's say over 20 years is 52,000. But what did the property value make you? 1.550 million. So you've spent 52,000 and you've now made 1.550 million. So you're netted $1.5 million. Who would spend 52,000 over 20 years and make $1.5 million? Everyone would if you knew, right? Okay, so this is the real basic side of property investing. And if you're young and you're busy and you don't have time for shares and all the rest of it, this is a really good thing to get into, because the taxman pays a third of your repayments, the tenant pays the other third, and you've just got to come up with 1/3 of it. And it's much, much cheaper to fund a $500,000 property that's rented out than it is to fund a $500,000 property that you live in yourself, because you've got to pay that from after-tax dollars, whereas here you're paying it from gross dollars, from before you pay any tax. So your cash flow is much, much easier to fund. Okay. Yeah, of course. Yep. It's a lot less. Yes, you don't get the depreciation. There's two parts of depreciation: depreciation on the building, and there's depreciation on carpets and fittings and that kind of thing. You'll still get the carpets and that, but you won't get the depreciation on the building because it's older. I'll show you some of the problems that you can come up with. Okay, so looking after people's taxes and things for many, many, many years, you start to see problems that occur from investing. And if you're aware of the problems, then you can avoid them, right? So generally, Tony and Sue, young couple, they've got a child. Sue works part-time, so she's earning about $30,000 a year, and Tony is full-time work. He's earning $250,000, so he's on the maximum tax bracket, right? And whereas she pays maybe 10% tax, he pays about 48% tax. Now, obviously, some families are the other way around, but most families are the wife's at home working part-time when they're young. So they want to buy an investment property. Okay, so you go along to an accountant, but the accountant doesn't specialise in property. He's just an accountant, and he just does your tax return for you. So, and he's not a Chan and other accountant, he's just the accountant down the road. There's the accountant down the road, all right? So you go along to him and you say, well, whose name should I put it in? Because it's really important whose name you put it in. You don't just buy it in joint names because it can cost you a lot of money. So his advice would be what? Whose name would you buy it in? Would you buy it in joint names? No, that's right, because if you buy it in joint names and it's negatively geared, then Sue's tax rate's only 10%, so she gets a very little refund. And Tony's tax rate is 48%, so he gets a bigger refund, but you've lost the maximum refund because you diluted it with Sue. Okay, so whose name should you buy it in this situation?
In a trust.
Let's not go there. Eventually I'll talk about that, but at the moment we wouldn't put it into a trust because in New South Wales or in most states, you don't get a land tax threshold with a trust. They tax land tax from the very first dollar. So if I had it in my name and I had it in a trust, then I'll pay an extra, the trust will pay an extra, which is you, the trust is you, you'll pay an extra $6,000 land tax, right? And if I had it in my name, then I would say I wouldn't have paid any tax. So your very first property, if it's in New South Wales, you don't put it into a trust. Once you've used up the land tax threshold, which is around 900,000, once you've used it up, you might have 1 or 2 properties, then the third property you put it into a trust. Because you don't get a land tax threshold, but it doesn't matter because the third property you're already into paying land tax. And there are a lot of benefits in a trust. And if we have time, I'll talk about those. And Chan and I have developed our own trust, which is called the Property Investors Trust. And we've got an ATO product ruling for it. So it's been approved by, so it's legitimately used. So I'll just stick to the very basics at the moment, so I won't go to the trust area. So the accountant would say, put it in Tony's name. You put it into Tony's name because he'll get more of a refund than Sue. Okay, so at this point, the audience would say to me, yes, but what happens if they have a divorce? If it's in Tony's name, won't he take the property? Well, the family law court doesn't work like that, right? The family law court doesn't look at, the assets don't go to the person's name that got their name on it. The family law court looks at the welfare of the children. So if the children are young, if the children are 18, it doesn't matter, it's 50-50. It doesn't matter who brings what income in, it's just 50-50. But if the children are very young, they want to try and maintain the environment because the children are the ones that suffer the most in a marriage breakdown. So what the courts try to do is to try and maintain the environment for the children as best as possible so that it causes as least stress as possible to the children. And that means if they're living in that house, they want the kids to continue living in that house. If they're going so that they can go to the same schools, have the same friends and so forth. And if the mum, generally it's the mum that's looking after the child, they get custody of the child. And then at this age when they're young and the kids are young, the mother generally gets around 80% or more of the asset distribution. And you might say, well, how come she gets so much and he gets so little? It's because in this situation, it could be the other way around. I'm just using this example. The mum would have given up their career. They stop for a good chunk of it, whereas the husband's career keeps going forward and he continues getting promoted, doing well, earning income, whereas the wife's career has stopped. To equalise it out, they give more of the assets to the wife so that when she then comes back to work when the kids reach 18, then it's not an exact science, but it sort of tries to work out, right? So it's a fair system, but obviously not everybody sees it as being fair, but it's a reasonably fair system. So that doesn't matter because it's in Tony's name. If they do split up, the courts just look at the welfare of the children and they divide the assets up according to maintaining the environment for the children. So the other problems with doing that is if you use an accountant that doesn't understand the long-term consequences, because property investment is a long-term asset. You can't structure it short-term because lots of things change. It can go from negative geared today to positively geared. And generally about 7 or 8 years, it goes from negative geared to positive geared. And then if it's positively geared, then what happens is the rent then goes to Tony, who's on 48% tax. So you're losing a lot of tax now, right? So this is, the accountant would say, buy it in Tony's name. But the problem is there's a long-term problem. The property becomes positively geared and then you now end up paying higher income tax. So then you go back to the accountant and said, well, this is not good. I'm paying so much tax. And he'll say, well, buy another property and add it to your side to get the tax deduction. So eventually, Tony has like 3 or 4 or 5 properties, right? And then they hit the land tax threshold, and they start paying a lot of land tax. So there's when you invest in property, you've got to look at the short term, the medium term, the long term. You've got to look at income tax. You've got to look at land tax. You've got to look at capital gains tax. Because if it's in Tony's name and you come to sell it, the capital gains tax is at his tax rate, not at Sue's tax rate. It's at his tax rate. So you end up paying quite a lot of capital gains tax if you sold. But if you didn't sell, you don't pay any tax. Right. And of course, if Tony was someone in a litigious position, he could be a director of his company running his business, and directors get sued, right? They're a high risk, they're at a high risk category. Or he could be a doctor or someone, a profession that is high risk, and you've got all your assets in the highest risk entity, which is Tony, and the safest risk entity, because she's only casual, she doesn't have any assets in her name. So from an asset protection point of view, that's not a good way to structure it. So you can see that it's not just, let's just buy a property in both names, right? So you've got to consider these considerations. And the most frustrating thing for me is that someone will come to see me on Monday and say, guess what, Ed, I just bought a property on the weekend and I put it in X, Y, and Z name. And you think, oh no, why didn't you come and see me before you buy the property? We need to work this out before you go and do that. Because once you bought it, guess what? You've got to pay stamp duty. And if you try to change it, you've got to pay stamp duty again. Right? So it's very expensive. So you need to see an accountant that knows what they're doing, that considers all these things. And at some stage, you need to bring a trust in, but not the first one generally. Okay, and of course, we covered land tax. And there's estate planning issues, and we talked about the stamp duty. If you get it in the wrong name, you want to change it, you've got to pay another lot of stamp duty. So it's very expensive if you get it wrong. So it's always best to prevent and get someone that knows how to structure the property side. Okay.
So
yeah.
in that case,
Yep.
you're not recommending buying a property in Tony's name then?
Yes, I do. Yes, I am. So in that case, I would buy it in Tony's name, and then by the time we get to the second property, depending on the land tax, if they've breached the land tax threshold, once they breach the land tax threshold, I put it into a trust, right? And the types of trusts, they're all different types of trusts, and this is the property investor trust that we've developed. Right? Now, I haven't got time to cover the trust, but I'll just jump to one last slide, and I'll bring David on. Okay, so some of the clever things that we do, which nobody else does, is this. Let's say the typical example is mum and dad owns a house and they want to upgrade. Okay, so they want to go to a better house, and they're living in this house and they pretty much paid the debt down. So they've paid it right down. And if they want to upgrade to the next house, it would be worth more. So they've got to go to the bank and borrow more money to buy that next house. Now, the deductibility of the interest depends on where you spend your money. You can put the security of the old house up as security for the bank, and then you rent that out, and you think, oh, well, I'm renting it out, I can claim the interest as a tax deduction now. But no, despite the fact that you've used the property as security, but the security is to do with the bank, not the ATO. Right? So the ATO doesn't look at it like that. The ATO looks at the money that you borrowed, where did you spend that money? So if you spent that money on the new home and you want to live in that new home, then it's a private expenditure and it's not deductible. Okay, so if you want to retain your old house, but you want to buy another house and you want to upgrade to it, then it's very, very expensive, because all your equity is tied in the first house, and you've got all the loan spent on the new house, and the new house is where you're going to live, right? So then it's not deductible. So this is what you can do. This is some of the clever things that we do. I'll go through this very carefully so you don't get confused. So this is the old house. So John and Sue living in this house is worth $1 million, right? They want to buy this new house, and let's say it's just nice simple numbers. It's worth $1 million, all right? there's no more debt in this house. They've paid this off. So they've got to borrow $1 million, a new $1 million, to buy this new house. And they're going to move from that house down to here, and they're going to rent that house out to a tenant. The banks would take that as, happily take anything as security. And even if you put that up as security, which the banks may insist on, it doesn't mean that you can claim it as a tax deduction, because that's the rule for the bank. It's not the rule for the ATO. The ATO only looks at where did you spend your money to determine the deductibility of the interest. So in this situation, where did you spend your money? Here. And because you're going to live there, it's non-deductible. Okay, so let's do something really clever and change this into a tax deduction. This is all done before. We do all this, and it's all fine and everything. So what happens is this old house is in John and Sue's name. Okay, so what we do is we set up a trust, a property investors trust, one of the trusts that we set up. John, because John's a higher taxpayer out of the two, right, he pays more tax than Sue does, he'll go and borrow $1 million from the bank, and he'll buy $1 million worth of units in the property investors trust. So it's a bit like I borrowed $1 million and I bought $1 million worth of shares in BHP. It's a bit like that. Okay, so now the $1 million goes from the bank to John. John uses it to buy $1 million worth of shares or units in the trust. The trust now issues 1 million units to John and uses the $1 million in cash and buys the property or buys the life interest of the property from John and Sue. So if you buy the property from John and Sue, you transfer the title to the trust. If you buy the life interest of John and Sue, you register a life interest on the property. The property stays in John and Sue's name, but John and Sue no longer owns it. The trust owns it because it's got a life interest over the trust, or over the property. But let's just keep it very simple. You transfer the title to the trust because the trust has bought the property. So the property transfers to the trust. In return, $1 million goes to John and Sue for selling the property. They've now got $1 million. Right? What do they do with that $1 million? They pay off the loan. So this is a non-deductible loan. They've paid it off. But this is now a deductible loan because you're renting that house out. Question?
Stamp duty.
Yes, sorry, I was going to get to that. So there's stamp duty to pay. Once upon a time, there was no stamp duty paid on life interest, right? But now they cotton onto it and they're now charging stamp duty on it. So you've got to pay the stamp duty. So you've got to sit there and work the numbers out. So I've got to pay stamp duty. I'm claiming the interest as a tax deduction. I'm saving, $5,000, $6,000, $10,000 a year in income tax. I've paid $50,000, $60,000, $80,000 in stamp duty. It's going to take me 8 years to break even, and then I'm ahead, or it's going to take me 2 years to break even, and then I'm ahead. Right? So the numbers you've got to work out to determine whether you do this or not do this.
So is there a capital gains tax in that?
No capital gains because it's their home. They're selling their home across. So there's no capital gains
So a
tax.
transfer of the life interest from the home is not a capital gains tax.
Because it's a home, yeah. The determination of a capital gains tax is based on what you did with that property there.
So do you have one trust and multiple properties, or do you have one trust per property, so that if somebody, if a tenant sues you through one property, it doesn't affect the others?
Great question, great question. There's a lot of other things to consider, and that's one of them. But I've found, being in the game for a long time and doing a lot of tax returns for a lot of people, a tenant you don't really get in trouble for a tenant suing you. And generally, if that happens, you've got insurance to cover it. So I generally don't set up separate trusts for separate properties because it can be quite expensive. The other consideration is land tax. Right? Now, some states, like New South Wales, have no land tax threshold per trust, but in other states they do. Right? So some other states like Queensland, they've got I think it's 500,000. Cindy, you better tell me.
300 per trust.
300,000 per trust. Yes. So you can say you don't have to pay any land tax in Queensland. Every time you use up one land tax threshold in one trust, you set up another one. and put the property in the other one, and then you don't pay land tax. And you keep doing that and you never pay. We used to do that in New South Wales until they changed the law.
Or you can combine them. You actually can combine 2 or 3 trusts to buy a single property.
Oh, you can if you're still within it, because the land tax threshold goes per trust.
Yeah,
So
300 per trust.
per trust.
You bought the property that's 500 or 600.
No, you can't put the 2 trusts together to get the 300,000.
I got one as such that was set up for that.
2 trusts gives you 2 lots of thresholds.
Yeah,
Yeah, per trust. Property per trust will give you.
for one property under 2 trusts.
No, you won't, because land taxes are charged on per trust. Okay, you can come and talk to me later. Yeah, I've got to keep going. Yep. All right. So I just thought I'd just quickly share with you. Last question. Yeah.
Quick question. So right at the beginning, Tony's got the $1 million. Banks give that to him.
Mhm.
Right? What's their security?
The home.
Bottom line.
Either one. Either home is fine. The banks won't care what you put up as security. They'll take whatever you put up.
Right. But they want the title
Yes, correct.
of that property as their security.
Possibly both. Both
But
properties.
then when you transfer in the life interest or whatever you call it,
The title, yeah.
trust.
Yep. The title will be in the
Is there
trust.
a conflict there between the banks and hang on a minute?
Oh, no, it won't. Because you can buy a property in your name, you can buy a property in your company, it doesn't matter, or your superannuation fund, it doesn't matter whose name it is, they'll just take that property, it doesn't matter whose name is in, as security. So it won't matter whose name it is, they'll just take it as security.
Good evening, my name is David Naylor. I'm one of the founding partners of Chan and Naylor, an accounting group located in Pymble. I'd like to welcome everyone here tonight for our seminar on property, trusts, tax structures, and also a general update on the property market and how it looks in Australia leading into 2025. Thank you very much for your attendance. My role tonight, I'll be quick. I've only got 20 minutes, so I'm going to be quick. But what I want to do, I'm the property guy. I used to be an accountant with Ed. I don't do accounting anymore, but I've got a real passion for property. And I keep my eye on property, I follow property. Ed and I have invested over the 40 odd years in commercial property, industrial property, residential property, all sorts of property. We've developed property, so we've been through everything in property. And I always follow a number of different experts in the industry. I watch the Googles and all the sort of YouTube. So I thought I'd put together a few things for you just to highlight where we're currently at. When I used to start golf here 20 odd years ago, I'd look in the horizon behind you and you could just see sky, but now all I see is high-rise buildings, right? And we're heading into a new era of property, and mainly due to the fact that many people that are sitting in this room now and their age group are coming to a point where they're retiring, the baby boomer phenomenon. It's actually going, everywhere along the track, the economy has changed when the baby boomers have moved their life through their life cycles. And we're about to see a big change happening over the next 10 or so years because of that, especially in the property area. So what I'd like to do is just go through this with you. The 2 biggest issues at the moment is housing affordability and lack of supply. We've all heard the government, even if you watch the news over the last week or so, or 2 weeks, it's been on the news, front page news, is affordability and lack of supply. They're the biggest issues we're dealing with real estate at the moment. Affordability, obviously with higher interest rates, higher property prices, you know, it's more expensive to get into the market. We all know that's quite obvious. And the rates of 2 and 3% that we experienced over the last 5 or 10 years, they've gone. We're now heading into a period of sustained higher rates. We may see cuts towards the end of, middle to the end of next year, but the cuts won't be significant. We'll always be sitting on a mid-range rate. So the days of the 2 and 3% rates, I think, have gone for at least the short term. And to avoid financial stress and to avoid the difficult decisions you need to make in life, your mortgage payments need to be no more than 30% of your household income. And at the moment, if you look at some stats, for a lot of people, it's exceeding 30%. So it's putting a lot of pressure on households. All sorts of different problems are occurring. So that's what the government is assessing at the moment. They're looking at trying to sort this out. Now, the old dipping into the bank of mum and dad, I look around, I see people that we'd all have children, I'd imagine. And for the people that were born, you know, between the ages of the years of 1946 and 1966, I think if they've bought real estate, they've probably done okay. And with their kids that are growing up now, they're trying to help them out. And we often get clients coming in and say, how can I help out my children? The affordability issue, you know, blah, blah, blah. So what we try to do is we talk to our clients about, look, certain strategies you can use to help your children get into property. And I'll just discuss a couple of those. Moving back home or not leaving home to save deposit now takes an average of 10 years to save a deposit in today's world. Back in our day, in my particular day, it was a lot less than that. Because if you look at by the time a boomer was 39 years of age, they already owned their own home, of which 19% owned it outright, no debt, compared to now, 5.7% of the Gen Y generation. So it's becoming, the affordability side of things is a big issue for government. Now, if you look here, living at home with parents, in 21, 54% of men and 46% of women were living with their parents at 30 years of age, compared to 46 and 35 10 years earlier, 20 years earlier, sorry. So as you can see, because of affordability, people are staying at home, trying to save deposits, trying to get into the market. And with that, the government has seen that, well, we need to change our policy on, you know, how we look at property. You know, self-contained secondary dwellings are emerging. Solutions such as granny flats. I mean, at my place, I converted the old garage into a granny flat and put my son in there, and he's been saving a deposit. Those sorts of things, they're all becoming popular now. Duplexes, if you look around the areas, duplexes now are a common thing. The councils are allowing, the governments are allowing a lot more development on smaller plots of land. Now, these are some of the strategies we talk to our clients about when they come to us and say, look, you know, I'd like to help my children into getting into property. And like Ed was saying, the earlier you get into property, the better off you are, and leveraging. Now, some of the strategies we talk about, and I'll just go, not one size fits all, you know, depending on your situation, depending where you're at, certain things. But these are some of the things we may talk about when you come and see us. Gifting, you know, obviously the easiest option is I'm going to gift you a couple of $100,000 or whatever, and it gives you a leg up and start a deposit for a property. The problem with that is there's a breakdown in the relationship. You've gifted them $200,000 or $300,000 for the deposit. Obviously the breakdown in relationship, then some of that money will go elsewhere. So that's a bit of an issue. So we discuss that with our clients. Ed mentioned granting security over mum and dad's home is a risk to mum and dad, because if something goes wrong on that side, the bank's going to knock on your door, not on their door. And, you know, you don't want to be put off for that. So there are issues there. A popular one that we use is loan agreements. You lend the money to the children on a commercial basis. Doesn't have to be they have to pay back the interest automatically or pay capital payments back, but it needs to be written in such a way that it can't be seen through as being a bit of a rort type thing. So a loan agreement is a popular way where you can call back on the loan if things go wrong. Now, buy property in your own name. Just as Ed showed you, investing in property, you've got equity because you built that up over the years. You just go out and buy a property, an investment property, and allow them to occupy that property. You know, when you sell that to them, if they wanted to buy that off you later on, there's CGT and stamp duty issues. But, you know, depending on your situation. Alternatively, you can wait till that property goes up in value and you can use that security of that property for them to move on to the next property. So there's those sorts of things you can look at. Or, as Ed spoke about, you can buy property in a trust, property investors trust, and at some point you resign as a trustee and they come in as a trustee. You can do that with a company and shares and things like that as well, where you can transfer ownership without paying the CGT and the stamp duty. Supply, big issue. I'll just go through these numbers. I got these from the ABS the other day. In 20, migrant arrivals increased by 73% to 737 from 427 arrivals a year ago. Now, decreasing people leaving, but people are coming in. Now that's creating a perfect storm. Lack of supply, affordability issues. And I'll go through that in a minute, why we're having issues with the lack of supply. Now, there it is down there, really. ABS figures show that the commencement of new dwellings fell to its lowest level in 18 months in the June quarter. Meanwhile, building approvals are declining, and total dwellings approved in September quarter were down 5.8%. So it's a perfect storm. We're not building enough, and we've got people coming in. Where are we going to house these people? So the government are full foot to the floor trying to sort out this particular situation. They know it's a problem coming. Some of the strategies that will help with supply that the government are implementing is obviously the common one was the average size of blocks are reduced in New South Wales through government policies, duplexes and the like, and you'll see a lot of that. Small apartments in many residential areas. High rises, it's a big thing at the moment. The government has put out a policy recently where, and you can see it, some of the major centres, they're increasing the heights of high rise. So instead of being 15 stories, we're going to 20, 30 story high rise. Not uncommon if you've well travelled places in Europe, apartments are everywhere, and that's probably the way we're heading here for sure. It's interesting, in 2020, apartments made up 21% of homes in Australian East Coast capital. So that's where we're heading. That's the direction. And height restrictions are changing. Notable developments, Parramatta up the road here, you're looking at 35 or 36, average of high stories. In Melbourne, they're going up 23, in Brisbane, 12.5 stories. So there's developments that are happening upwards, using the airspace around them. Now, with the supply is not keeping up with pace due to the planning delays and the building costs and the shrinking developer finance. It's so hard. I've developed, Ed's developed, and in today's market, trying to develop, we've looked at sites and it's near impossible. The numbers just don't stack up to do a development with the cost of finance. The building costs are going through the roof. So therefore, the government has to encourage builders to come into the market by quickening the process to get a development through. But at the moment, there's no signs of that. There's signs of the government trying to assist builders, but there's no sign of anything happening anyway in the early 25. Perhaps towards the back end of 25, we'll start to see some momentum. With that in mind, established apartment price growth has outperformed house price growth in Brisbane, Melbourne and Hobart, which is the first time it's done that for quite a while, because they're not building them. There's nowhere to live. The scarcity of newly built apartments in recent years is expected to place an upward pressure on apartment prices. So if you're looking to invest, it may not be a bad time to invest in the moment, because when these new properties come on the market down the track, the builders have spent more money to develop it. They've spent more money on the finance. At the end of the day, the property will cost you more. That's how it works. Okay, these are the recent government. This was only this week. These announcements came out. So in Sydney, which we all live in, there are rezoned developments announced across the Sydney North, Crow's Nest, Macquarie Park, Kellyville, Belly Vista, Hornsby, and also just across here at Homebush. So they're looking at rezoning the developments for high rise. So we're talking multi-level story properties. And they're looking to inject about 60,000 homes when that's complete, which is a start for the supply side of things. For the affordability, they're offering a thing called build-to-rent schemes across Australia, just meaning that some of the developments that the government will get involved with developing will only be available to renters and not to purchasers, which frees up a bit of availability from affordability point of view. So that's a scheme that the government is bringing in. This other issue here, government to cut red tape. So they're allowing some of the red tape in development of proposals to get through quicker. Help to buy schemes. Now, this is something that the UK do this, because I've looked into the UK. They do this, and I'm not sure how they're going to do it in Australia, but the federal government will give buyers that take part in that scheme an equity contribution up to 40% of the cost of a new home, or 30% of their existing, or 30% of existing homes. So the buyers will need to pay a mortgage on that for their share, but won't need to pay the rent on the stake owned by the government. I suppose it's similar. I remember the old Housing Commission days, way back when. It's not like that, because you actually have to contribute something, but it allows you to get into the market. And I don't, at this stage, know what the criteria is, who would be eligible for that type of scheme. Okay, but something to keep an eye on. This is massive, and this is probably going to change the landscape of the Australian property market over the next decade. 46 to 60. Anyone fall into that category here? Hands? Born between 46 and 66. Okay. Women don't want to put their hand up, do they? Okay. So me. Okay. So the baby boomers are going to make major life decisions over the next decade or so. And this is an interesting stat. They hold nearly half of Australia's wealth, despite being only 21% of the population. So the momentum with whatever they do creates a wave behind them. So if you look, they own over 60, Australians over 60 own 4.5 trillion worth of asset, with 3 trillion of that in property. So it's massive. And that's going to be passed down to, generation below that in the coming decades. Now, boomers retiring, 710,000 Australians intend to retire in the next 5 years. And many of these people will be looking for a sea change, and they'll take their generous budgets from the sale of their properties in Sydney and move to more affordable coastal areas. So that's something that we need to be mindful of if you're investing or whatever. And there should be a steady price uplift inevitable in those most popular locations. So that's and now if you're over 55 as well and you're downsizing, have this government has announced a scheme where you can access 300,000 of that sale price and put that contribution as a contribution into your super fund.
Just a quick question. When you say downsizing, so say if you change home from one, when you're actually not buying a cheaper home, when you're buying an expensive home, can you still contribute? Do they look at the difference in your purchase price?
No. If you're downsizing, so if you're selling your principal place of residence and you're moving to a sea change or a coastal area, well then you can take the cash that you've got, contribute into superannuation, 300,000.
What my question is so say if you're buying the house similar price, but you've got cash elsewhere.
Cash from elsewhere?
From elsewhere. So say you sell your PPR 1 million, you buy your next home at 1 million, can you contribute?
Yes, as long as you're over 55. As long as you're over 50, yes, you could do that. You could do that.
So you don't have to.
Yeah, but you better seek advice, as I've written there. Seek one-on-one advice.
Yes.
Yeah. Okay. Now, just some interesting stats, which I pulled out. 29% of people over 75 prefer semi-detached duplexes or single-level apartments compared to 22%. That's just quite obvious. You want to downsize, you want to reduce the area, space and maintenance and all that. 79% of Australians aged between that bracket prefer homes with no more than 3 bedrooms, which is, again, common sense. This one's a bit of an issue. Retirement villages are near capacity with only a 5% vacancy rate in 23. That's an area where I think that the government will also jump in and obviously will need to incentivise investors into that sort of a market. I don't know what that will be at this stage, but it's certainly going to be a problem. Downsizing interest in regional areas is growing, with Sydney house prices 48 higher, Melbourne 37, Brisbane 32 higher than the regional areas within their thing. So it's common sense. You'd sell your home in Sydney, you want to move to a coastal area, you put some money into your property and then you stick the rest in the bank or super or whatever and retire comfortably. Okay, current market trends. Look, if you're ever interested, McGrath brings out a report each year and it's very, very good. You just go on the website and search McGrath Property Report 25, and a lot of the stats I get came from that report. It's very, very interesting, but I've summarised a lot of the stuff that they've given me. Half the population is estimated to reside within 7 kilometres of the nation's coastline. God knows how they got that stat, but that's what they're saying. Interstate migration, Queensland is always the most favoured central and favoured area for especially Victorians. But the central coast of New South Wales is also quite popular now, and it's probably an area to keep an eye on because it's within a good distance of Sydney. It's on beaches, on coast, with all the infrastructures up there. So, and it's about 1/3 of the price of Sydney. So that's an area from an investment point of view. Any growth area within 150 kilometre radius of the closest capital city is, according to McGrath, going to be one that should grow over the next period of time because of the baby boomers and what they're doing. Sunshine Coast, Gold Coast, Lake Macquarie, Greater Geelong, those sorts of areas. And if you have a look there, the dwelling price in city coastal suburbs grew by an average of 11% nearly, compared to 8% across all suburbs and capital cities. So the coastal areas seem to be the ones that are moving. Just an example that actually McGrath brought up, Dover Heights is the most desirable coastal suburb based on their median value of 5.5 mil, compared to, say, Gerroa, which is down the south coast, probably a bit over 150k, but not much over. Which is the most expensive regional coast suburb with a median value of 2, which is 39% of the value of Dover Heights. So, and in Melbourne, similar sort of numbers come up. So, you know, baby boomers can sell their property, go and buy something in a beautiful place like Gerroa and bank 3 odd million and put some money in super and away they go. Queensland's a bit different. I've got some property in Queensland and in the Noosa Heads area, and that market has been booming, and if you look at that, the most popular region is Noosa, where it's about a median value of about 1.8, and it outpaces the Brisbane's coastal areas, which is unusual, but it's I can vouch for that. So you just got to be a lookout of different trends. Amazingly, this statistic is the Australian waterfront homes in the largest value up here in the Q1 of 24. Look at that. Look at the names of some of those places, and look at Sydney. You know, when you want to buy something on the water, it's quite expensive. Okay, just some more information. High interest rates and affordability have boosted the Perth market. Has been going gangbusters. You know, because of the high interest rates. Brisbane and Adelaide have been doing really well as well. So, you know, there's still markets to look for. And Brisbane is now the second most valuable capital city, which is interesting. Adelaide's home values are higher than Melbourne for the first time in 40 years. So there's another statistic that when I read it, I thought, wow, Melbourne has been overtaken. But in saying that, Melbourne is now the third most affordable city market in Australia, but this is expected to change. It's projected to become the most populous. When people migrate, for some reason, Melbourne is a very popular place to move to. So they will take the bulk share of that migration into Melbourne, which means, you know, obviously it put pressure for the property side of it. I picked this one out of their report just to give you a bit of a background if you're investors and you want to understand a little bit what they're thinking, because McGrath's got offices everywhere and they do quite good research. They're suggesting, you know, places like Summerhill, Dulwich Hill, Inner West, Light Rail to CBD could be something you can look at if you're an investor. Glebe, the Glebe area, Millers Point, Banger, stunning harbour views, East Lakes between airport and CBD, apartments, cottage. So if you're investing and you're thinking, where should I invest? You know, you consider the specialists who do this sort of stuff, maybe look around these areas. Bardwell Park, golf courses around there, CBD train, and this is Long Jetty, Central Coast, Sleepy Little Beachside, undervalued, best value on the East Coast. So that was an interesting comment, Long Jetty, Central Coast. Never been there, but maybe worth a look. All right. In conclusion, what I'd like to say from my experience, not being an accountant, but being a property investor, and I have a formula, I say if you invest early, plus you invest right, plus you stay healthy because you've got to live long enough for it to go up, right? well, then you'll end up reasonably wealthy, okay? So, and then you can help your children and do other things in life, etc. So, yep, so that's it. Just a brief overview, and thank you for your attention. Yeah. Speaking there, mate.
About the trust. So I got a trust, but I could not make tax deduction from it year to year. I have to kind of sell it to kind of.
You probably had a discretionary trust, did you?
I might have, yeah.
Family trust, yeah.
As a family trust, you're not allowed to, there's all different types of trusts.
Yeah.
And if your property is negatively geared, you don't use a discretionary trust, which is a family trust. There's another name for it, it's family trust.
Yeah.
You don't use that because it quarantines the losses inside the trust, and you can't offset it against your wages and other income.
Yeah.
So we set up a, you can either use a unit trust, or ours is called a property investors trust.
Yeah.
You can take the deductions out of there and claim it against your income.
All right.
You know, so you can convert it. Can we still convert discretionary trust to hybrid trusts? Okay, so sometimes you can actually convert your discretionary trust to a unit or a hybrid trust.
Yeah.
And then there's ways to do it, and then you can get it out of the trust.
Yeah, right. Okay.
Yeah.
Sure.
There's a common mistake by a lot of accountants who set up
Yeah.
clients into their, it's the wrong way. A big kind.
No, I just want to have a question about the trust. With your example with Sue buying the second house property,
All right.
would that be capital gains tax free
Because it's their home.
Oh, it is.
It's their
And
principal
even though
place.
they've got that life interest in the other, the life interest means that it's gone to the trust, so they have capital. That was their primary place of residence.
Initially, but because it went into a trust and then they rented it out, it's no longer their principal place of residence. It's an investment property, and then when they sell it, from that point to when they sell it, when it's rented, that's subject to capital gains tax. we know each other really well, so, so I said be kind.
So just to thank you for the presentation.
Right, you're welcome.
I think I first came to Chan and Naylor about 20 years ago.
Oh wow,
Everybody
thank
here
you.
would know that you guys are really generous with your time, so thank you for that. The question is, I don't understand the mechanics behind units rising to a higher median price than a house in the same suburb. How does that work?
Basically, the cost of development, because of basically affordability at the moment, a lot of people that come into this country can't find rental properties, right? If you can't find, or even the young people, you go to an open house for a rental property, there's a dozen people there. So what's happening is the price of to develop a property now is so expensive, and that's keeping out the developers. They're not building them. But when they do come in, and that's the only product that's available, it pushes the price up. Now you've got higher interest rates, you've got the price of building, costs of building has gone through the roof. So the unit that would have cost you to build, 5 years ago, 500,000, now costing you upwards of, 800,000-900,000. So because of that cost, it's pushing the prices of apartments up, and the demand for that sort of living. Because, you look for an average home in Sydney now, a young person to buy a home in Sydney, you're looking at 1.5, depending on the area, but you're looking at 1.5 to 2 million. You can buy an apartment for 600-700 in certain areas, or 800. So their get-in's a little bit easier, but the problem with the get-in, the get-in price is going up with the apartments, and there's a lack of supply because the builders haven't been out there building.
But it's a great question, though,
Yeah.
and I think also because obviously houses generally cost more than units, and your question was, how can a unit be more than a house? And I think it's because a lot of the baby boomers are downsizing, and they've sold their big houses and they want a smaller house, and a lot of them are going to units. So it's created a big demand in the units, so that's pushed their prices up disproportionately to generally these houses that go up more than
Because of the land,
units.
the houses go up because there's a land component, whereas with apartments, there's not really that land component. But it's a perfect storm at the moment is because of that affordability and the cost of building supply and demand pushes the prices up.
But it's not really happening in Melbourne though, in the city. The apartments in the city in Melbourne are very bad.
Are they badly built or badly?
No.
Maybe that's one.
The price is down. You know, it hasn't moved much.
Well, that's what I said. Melbourne's become, according to the McGrath report, Melbourne's become one of the most affordable places to go at the moment. You know, because of, for whatever reason, Perth and Brisbane and Adelaide are more affordable than
We know why. Just thank Daniel Andrews.
Yeah. Because the land tax, right? Like,
They really attacked property investors. You know, then everybody left. They left Melbourne and went to other states because they became they upped all the land tax. They made it so hard for them, so everybody left, and all the prices came down.
is it a temporary? I heard it's a temporary measure for they're going to recoup some of the costs that they spent during COVID and infrastructure and stuff like that.
Yeah,
so it's like
I don't know. Yeah,
5 or 10 years.
Don't know.
Land tax.
yeah, I don't know. Yeah, because they.
Not sure if you saw the news yesterday.
You should find-
Victorian government, state government debt
Yeah.
was the highest at the moment
Yeah.
amongst all the other states.
No, it's huge.
So
Daniel Andrews has just run them into the ground.
it's all
Exactly.
about
Yeah.
economy, right? So you gotta make the numbers back into the black, and
Yeah.
therefore it's just how long it takes.
I mean, you know, you can see in my suburb, because I live not far from here, every home that goes on the market, developers are buying those houses and putting duplexes on them. You'll see it everywhere, really, probably all around the area here. And you know, you're cutting one resident into two. So over time, that will absorb some of the supply demand. You know, but the prices they're even asking for those duplexes are ridiculous. You know, like. So it's just a perfect storm. But you've seen in the media over the last week the amount that the government just put through the legislation through the Senate to make things a bit easier. We'll see what happens.
Can I just say that, you know, property is just a means to an end, right? Because when you get to the end, like when you're older, it's really hard to live off the rent of property because you've got to have a lot of properties to give you the lifestyle you need. So what I do is, and I sell down some of it and I go into shares or funds management or something that's more cash flow liquid. So it's just a tool that you need. But when you're young, you want the asset base to be as big as possible so it can, you know, grow. And that's why property is great. But when you get to, you know, retirement age, the rent as a return is very little on property. It's great on the capital growth because you can increase the asset base, but then to live off it, cash flow is not that good. So you then have to sell down some of it. So you don't get attached to it like it's your home. It's just a means to make money, right? And you use the tool, and it's just a tool to make money for you. And then, you know, it's not emotional. You don't hang on to it forever and all this kind of stuff. It's when the time is right, then you cash out of it and make sure you do, because you don't want to be asset rich and cash flow poor and live like a pauper when you've got heaps and heaps of assets there sitting there. And some people do that. You know, that's silly in my book.
And that's what the baby boomers are doing, or will be doing, as they're selling down, releasing some equity, using that to live off. You know.
What about people live off equity? Would that be like a strategy when you?
Yes. The problem with that strategy is, I've just explained, living off equity is that, you know, as your property value increases, you go back to the bank and then they lend you more money against the increased equity in that property, and then you draw that down to live on, right? But the reason why I don't like it is because, one, the banks change their minds about that all the time, you know, and then you think that, I'll use this strategy, and then they pull back on it, and then you don't get any more money. That's one. Number two is compound interest is huge. So if you're not paying the debt off and you're just capitalising the interest on the debt, compound interest is really bad on the opposite direction. Right? It's good on this direction, but it's also really bad on the other direction. So you've got to be really careful about that strategy.
Here's a real story. One of my friends, they had a lot, but his parents his parents got a lot of property, but his parents sold up a lot of them, like for at the time a lot of money. But that's 15 years since, and they have like 2 siblings, 2 kids, and the parents actually regretting selling it. They could have say, all right, I'll take some money out and let you pay off the loan, while passing on allow that property to be inherited to the kids, and in a way that is more effective for the later generations. At the time, you're keeping the asset while it's growing.
Yeah, everyone's situation is different. So, you know, like it's all, you can't look at it like, oh, we should do this, but you got to look at your own situation.
Yeah.
And, you know, if you don't have any cash flow and you're living on a huge asset base, that's silly. You know, like you got to get the balance right. Yeah, you got to get the balance right. So, all right. All right, I think, question. Oh, sorry.
For those who are people reading your book, for those who already started to purchase the investment property, you know, or a few properties already on the individual name, do you recommend those you know, already purchased properties are negatively geared at the moment? Do you suggest to convert the ownership from individual to trust, or just keep buying these?
Yeah, no, I wouldn't do that. Now, there's only a couple of reasons why you'd want to consider changing it, right? One is because every time you change it, there's a stamp duty to pay and there's capital gains tax to pay. So you don't want to change it. What you want to do is you want to make sure that the new ones that you buy are set up correctly to balance out the wrongs that you made initially. So the other reason why you may want to get it out of your name is you're a professional. You're a high-risk person that people can sue you, you're a doctor or someone that's in the high-risk category, and you want to get any assets out of your name, all right? Now, we don't recommend you moving the property out because of stamp duty and capital gains tax. We've come up with a strategy called an equity bank, where we can strip the equity out of that property. It's still in your name. Strip it out of your property, there's just no equity there. So people won't sue you if you've got no equity. They're only after money. As soon as they find there's no money there, they'll give up. So we have a strategy for that. And to answer that gentleman's questions earlier, I can't remember where it came from, but in the situation where Tony and Sue, if Tony was a high risk in a high risk industry, with the first property, we're still buying his name because he gets the land tax threshold in his name. But if he's a high risk category, like a doctor or something, then we would then attach an equity bank attached to it to strip the equity out. Now, initially, the debt would be very high on this, so the equity is very low, but then every 10 years it will double in value, the equity increases, so our equity bank strips that equity out, so it gives him his asset protection, and he gets his land tax threshold.
So what my understanding is that the first thing that lawyers do, my understanding is that the first thing that lawyers do is they look at the title deeds, and if they see no covenant on a property, that's like go for it kind of thing. Can people put watches on that? So you're talking about what you were saying before about stripping the equity out.
Mm-hmm.
If you're putting covenants on it, will people look at that and say, oh, we were going to sue you, but now you've stripped the equity out, you put a covenant on there, which is basically a mortgage.
Correct. Mortgage. Yep.
Can they actually watch that? Or?
Yes. Yeah, well, that's exactly why you do it. So you set up a trust that you gift the equity from the property to the trust. The trust lends the money back and registers a second mortgage on the property. So if the bank had a first mortgage, you register a second mortgage. If there was no mortgage on there, you'd register a first mortgage. And then you got that, when someone looks at it, they go, oh, there's no equity here, so I'll leave you alone.
But there are clawbacks.
From a legal perspective, if they see you doing that before, like if there's an event and then you strip the asset,
If there's,
then from a legal perspective,
it's called a clawback provision. So if you do it within 4 years, so if there's no event, you can do it. But if you do it, if you're aware of an event and then you did it, then there's a 4-year clawback period. So you got to do it now when there's nothing happening, but you don't do it when there's something happening. they'll claw it back. It's called a clawback provision. Question?
I'm just thinking, let's say, I know Australia doesn't have any inheritance tax. I just have this question in my mind, like let's say you're...
Although Jim Chalmers tried it on, and I just heard that he tried to introduce unrealised capital gain. That's an inheritance tax, right? And it's not indexed. Anyway, it didn't get through the Senate, so they've now dropped it. So sorry, go back to your question. Yeah.
But I think there's an unrealised capital gain tax in the super or something like that, right?
Well, they were trying to introduce that recently. Not now. The other day they've dropped it.
My question is that, like, you get an inheritance. Let's say you inherit your parents' property, but you want to keep that house. So then you have to change the name over to you. And do you still have to pay stamp duty and all this other stuff, or is that because of an inheritance?
No. If you pass your assets to your children before you died, right, then there is stamp duty and so on. After you died, there's nothing. The only thing is if you come to sell it, right, then there's tax when you sell it. But they give you 2 years to if it's your mum's house, then you get 2 years where you can sell it without any tax. And then if you hold it for more than that, then you can
what if you
tax
live
it.
in that house? I'm just thinking.
If you turn it into
like I know someone. Well, in the old generation, like in past generation to generation, you don't pay the inheritance. Like so, you live there for 20 years as your primary residence. You still have to pay after, like it's okay.
No. If it's your principal place of residence, there's no tax on there.
So unless you keep it as an investment property,
Correct.
and you sell
Correct. Yeah. And in fact, if you lived in it and then you moved out and you rented it out, right? As soon as you rent it out, it's subject to capital gains tax, but you've got a 6-year provision of not paying capital gains tax as long as you continue to nominate that house as your principal place of residence. You can move out and live somewhere else, but as long as you nominate that house as your principal place of residence. And then as you approach the 6th year, if you move back in, you re-trigger the 6-year provision. At least 3 or 4 months, they say. There was no like criteria, but they look at each case. But generally, we've found about at least 3, 4, 5 months. The longer, the better.
So once what you talk about here about moving in and out of principal places of residence, once it attracts capital gains tax, once it attracts land tax, does it always attracts land tax even if you go back into it?
No. As soon as because as you know, land tax is a state tax, capital gains tax is a federal tax. So when you move into it, it triggers the re-establishment of the tax-free status from a federal point of view, which is a capital gains tax. But it's subject to land tax as soon as you rent it out, because it's a state tax. They've got different rules.
And that's forever. So if you have a $2 million property, or $2 million worth of land, and it's your principal place of residence, you don't pay land tax on it. But the second that you
rent it out, subject to land tax.
That is subject to land tax, and then even if you move back into it, it's
when you move back into it. Oh, sorry, Sydney, you can answer.
Land tax look at your arrangements every calendar year. So if you move back and live in there, and during that calendar year you live in there more than 6 months of the calendar year, you need to report to government, the state government of the status, and they'll waive the land tax and give you back your home status again. Yes. So they assess you every calendar year and based on your living period in any given year, from year to year.
I have another question. I think I made, let's say, I think I made a mistake anyway, put it that way. So I borrowed money in a trust, okay? And every year you have to redistribute whatever profits you have to distribute out of the trust. So you never ever get to pay off the loan in the trust. So how do you go about?
The debt is trapped inside.
The debt is like trapped in the trust. So how do you go about getting rid of the debt without selling the property? Of course, if you sell the property, you zero everything out. But if you
I assume it's a discretionary trust, because they're all different types of trusts. Cindy can answer that, yes, Cindy.
Yeah, unfortunately, the trust has to borrow money from the beneficiaries to get the funds and pay off the debt. So it's like a refinance.
So that means then the trust will owe me money.
Correct. So the trust will do one way or another. Either the trust has to sell the property to pay off the debt, or the trust has to borrow from elsewhere. So it could be an interest-free loan from the beneficiaries if the trust is desperate to get rid of the bank loan.
So I told you she's smart.
My question is to help the children because want to retain the name in the child's as on the title, so they can get the CGT concession as a home when they sell. So what is the best way to go about to help them if we want to have the child to retain the name on the title, so they can access to home status when they sell?
Loan, I believe it's the loan, lending the money to them, depending on and drawing up a commercial loan agreement. So you're lending the deposit and then they buy the property in their name. Alternatively, you can put it into a trust or a company, and you can be the trustee, but you can resign and appoint them as trustee at some given point in time, and then they take ownership of that trust which has the property in there, and then they can continue on with that.
I'd be careful in New South Wales because you don't get a land tax threshold, so you'll end up paying land tax on it. In Queensland, that's okay because you get a $300,000 land tax threshold in Queensland. You can put it into a trust and you won't pay land tax as long as the land value is under $300,000. But in New South Wales, just got to be careful with that one.
I'm thinking about giving them the deposit plus the interest, the commercial interest, but not calling on the interest, and just compound the interest whenever I can call. That is still a commercial.
Yeah, that's commercial. Yeah, that's common.
So they can claim the interest, but you've got to declare the interest as income.
No, they're living in it, I think.
Oh, they're living in it, are they?
Yeah.
They're living. Oh, okay.
Yeah, that's a common one. You just do the loan agreement, get a lawyer or somebody to draft it up, or you can just get one done properly, and lend them the money, get them to sign it, stick that away, and that gets them going. Title in their name and all that. Yeah.
If that's for the purpose of protecting the children's relationship risk,
this is what I'm worried about.
The family law lawyer might ask you charge a little bit to get repayment. Even if it's nominal, there needs to be some repayments happening. It can't just be completely repayment free.
The interest.
On the whole. So the family law these days gets smarter.
I think it was an absolutely fabulous event. I've been coming to the Chan and Naylor events on and off for about 20 years, reading the blogs, looking at the website, and they're always extremely generous with their time. The information is phenomenal, and you can just never stop learning.
I thought it was really informative, hearing both of them speak. Obviously, one person has more experience in one part of it more than the other. I think as a young person looking to get into the property market, it's a good place to go. And yeah, it was very, very insightful, and the way he brought down statistics as well, I thought was quite helpful. Yeah.
I have been with them for a while, and I've found them very helpful in the financial journey. And I was lucky I stumbled onto them. I first read their book, and that's how I was just looking through the sections in the bookstore, and then I read quite a few different books on finance, but I found their book gelled with me the most and was most sensible. And then I actually bumped into Ed through a mutual friend, but that was a long time after. I mean, I sought out the accountant group after reading the book.
I definitely recommend Chan and Naylor for any young person entering the property market.